Hello, Paul. How are you doing?
I'm
Good.
very well. I'm very well, thanks, Theo. And yourself?
Nice. Me too. Me too. Everything is fine. So today, price action, multiple time frame analysis. I mean, it's all a trader needs, right?
It is, when it comes to trading, hopefully it'll give new traders just a little bit of a simple introduction how to use multiple time frame analysis, just help them with their trade selection as they progress on their trading journey.
Fantastic, fantastic. Looking forward to.
Excellent.
Okay. I think you can share your screen anytime you are ready. By the way, Paul, do your webinar as regular. I will leave my laptop open because it will be recorded on my laptop now. There is some technical issue with the cloud. Okay, I will put it on mute and turn off my camera and do your thing until the end.
Excellent. Excellent. Great.
Okay.
Great. All right. Well, thank you.
Thank you, Paul.
Thanks for that, Theo. Hopefully you can see my slides and we're good to go. Great. Good afternoon, everybody. Fabulous to have you here. Thanks for joining us for the next in our Admirals price action series. Okay, up to session 49. Apologies. And today, as I said, we're going to talk about how to incorporate multiple time frames and price action into your trading. I think hopefully this will help people who are completely new to trading in terms of just understanding it and working out how they can utilize it. But I hope that those of you who've been trading for a while will also have something to take away, just in terms of understanding how to simplify it and how to make it part of your trading plan. It would be good to know, of those of you joining us here today for the live session, how many of you actually incorporate multiple time frame into your trading plan, into actually how you analyze and trade markets. Is it something that you do regularly, or is it something you've heard of but you've never really understood the best way to do it? It would be interesting to know what your own experiences have been. You can put them on the chat box there if you can do, and I'll look forward to seeing those comments there. As always, here we are, Admirals, a Forex and CFD broker that has a global presence but local support, and it's licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and giving you the opportunity to engage with markets on both the MT4 and MT5 platform. If you have any questions about Admirals, please get in touch with your account representative and they'll be very happy to help guide you. Teresa says, hello, for me, it's necessary to analyze several timeframes. Excellent. Okay, that's great. Thank you for that insight, Teresa. We might come back to that later, okay, as we start to sort of unveil and sort of unwrap this particular subject within price action. I'm going to give people a kind of just a bit of a basic introduction to it today, but there will be elements of it that we can talk about as we go through. So yeah, thank you there, Teresa. So, as always, we're going to talk about, well, what's price action trading? I would hope that those of you who've joined us previously would have a good understanding of that there, but I recognise that we have traders who are new to the journey, new to the series. But the main thrust today is going to be about the importance of multi-time frame analysis, how to incorporate it with price action, and how to use them together to trade more effectively. And I'll show a few examples, then what we'll do is we'll finish off with a little look at the live markets and see if there are any particular elements of it that have been showing up today, if we have the time. So stay with us to the end, because also I'll be talking about our session next week, session 50. I want to just make people aware of that, because session 50 next week is going to be a little bit of an interesting one, a bit of a different one. It's actually going to be a sort of an open session of me as a trader coach answering your questions about trading, and in particular price action. So if you've got questions about all sorts of the price action elements we've covered, next Wednesday's session will be a fabulous one for you to be able to sort of put your questions in, and we'll talk about it, and we'll utilize those kind of questions and answers as ways and means to help everyone elevate their knowledge about trading and trading utilized price action. So we'll cover a little bit more of that at the end of today's session, but stay with us, because we're touch on that, and we'll also have a look at the live markets. For those of you who don't know me, my name's Paul. I've traded for many years, traded for funds, traded for clients. Primarily, I like to focus on trading FX indices and commodities for myself, but I have traded many other asset classes. For my own trading, I tend to sort of find myself that I'm a trend trader for the longer term positions, which has an influence on what we're going to talk about today. And on a shorter term intraday and scalping basis, I tend to like to trade reversals. So, I'm hoping that, by now, session 49, people understand what we're talking about when we're talking about our Wednesday price action series. Really just helping traders from complete beginners to those who have some trading experience under their belts, recognize and understand how, just by understanding price action, understanding candlesticks, okay, we can utilize that to analyze markets and be able to sort of build simple trading plans that we can work with. We recognize that for many new traders, okay, at the start of their journey, sometimes it can be a bit overwhelming, it can be a bit intimidating, but just learning to understand and be able to read and analyze and action utilizing price action is a fabulous skill to have as a trader. And so each Wednesday, that's what we've been doing, is been talking about basically all the different aspects of price action. We just build your own knowledge and expertise in terms of utilizing that in your own trading. And you can see for yourself there, we've covered quite a lot, haven't we, in our session? And I say it every week. I try to cover a little bit of the hard skills and the soft skills. The hard skills being, the trade setups that everybody loves, things like engulfing candles, star formations, pin bars, key reversals, all right, the hard skills that everybody loves. But equally, the soft skills, okay? Soft skills about things like preparing yourself for your trading, having good routines, good processes, grading your trades, reviewing your trades, etc., managing risk. All of those elements which completely new traders sometimes underestimate or don't realize the importance of, but one that I can assure you after many, many years of trading that, it's those soft skills that are the things that will actually help develop you as a trader and help you make let's say, have a more enjoyable journey on your trading career. So we've covered an awful lot. The good thing is, for those of you, if you're just joining us, is that all of these have been recorded. They are all on the Admirals YouTube channel, so be sure to go in there. There's a sort of cornucopia of information, okay, and videos on there to help you understand markets and trading and help you in your own journey. And all of these are on there as well, so you should be able to find them to basically, either if you want to recap or you need to just brush up on a couple of elements, or there's particular pieces you've missed that you feel that you need to learn from. So we have covered an awful lot. And as I said, next 50 is going to be like an AMA, Ask Me Anything to Trader Coach Paul. So be sure to join us for that. So remember what we've talked about here, okay? And I always go through it every week, and I make no apology, because I think the more times you hear it, the more it embeds it, okay, as a simple starting trading plan, okay, that you can take and utilize for both your trading and price action in particular. We've talked about it a lot, namely that, step one, whenever you open a chart, whether it be Bitcoin, Eurodollar, gold, doesn't matter, okay? What we want to be doing is just defining our levels of support and resistance. Start the monthly, go down to the weekly, down to the daily, draw in those levels of support and resistance. Step two is we want to define, is there a trend in this instrument? Okay, good trends leap off the chart. You hear me say that every week, okay? If you feel as if you're not sure if it's in a trend, it probably isn't, okay? But if there is a trend, what we are interested in is there an opportunity for us to buy at a pullback, at support, in an uptrend, or is there an opportunity for us to basically sell at resistance on a rally in a downtrend? So we're looking to see, step three is wait to see, how does price react at those key levels? And those key levels, they might well be the support and resistance you've drawn in from step one. They might be things like big round numbers. They might be like dynamic support and resistance off moving averages, if you choose to use those in your own on your own charts. What we're looking for is at those key levels. Step four is let's look for some price action triggers. So, we've covered lots of them, things like pin bars, engulfing candles, star formations, key reversals, inside bars, all of these kind of price action triggers at those areas. That gives us a confluence of events that gives us a proper price action trigger that we can take a trade with. Step five is just before you do that, just take a step back and see, is it part of a bigger chart pattern? Sometimes we get so focused, okay, on the pattern and the trigger that you know, we miss as I said, we can't see the wood for the trees. It might be that we're part of a bigger chart pattern, and that might actually also be a tradable piece. Then we get on to what I call the back five, okay, the 5 R's. Step 6 is risk, all right? We never trade without a stop loss. We never risk more than a small portion of our capital on a trade. So the important thing about risk is you accept it and you manage it. Step 7 is reward, the flip side, okay? Are we going to have a target for our trade, or will we have a trailing stop? Make your decision before the trade goes on. Step 8 is record, okay? Make sure that you keep great records. Those of you who will have joined us for Admirals sessions with Dr. Alexander Elder, if you've read any of his books, he constantly goes on about the importance of keeping great records. And I can say from my own trading and from having coached, you know, thousands of traders over the years, you know, the ones who do well are the ones who keep great records of their trading. And then step 9, they review them, all right? They review their trades in order to sort of understand their KPIs so that they can improve their own trading. And step 10 is about repeating. If you've been keeping great records, if you're reviewing your trades, what you want to do is recognize your good trades. What are the good setups for you, okay? Which are the trades that work well for you? Because the reality is you want to repeat them as often as they show up, okay, for you. And on the flip side of it, okay, you want to basically start to cut out, all right, those sloppy, impulsive trades that everybody takes, okay? You're a human being, it happens, but the quicker you are able to identify what is your good trades, what are your sloppy, okay, indisciplined, unplanned trades, and start to reduce them and cut them out, all of that helps you sort of, you know, progress in your own trading journey. So there's sort of 10 simple steps there that any trader can take away. It's not the be all and end all, but if you're doing those 10 steps, okay, you are putting yourself on the right side of the market, okay, more often than not. And ultimately, that's where you want to be, okay? As you know, as even Jesse Livermore, okay, the great Jesse Livermore said, it's not about being on the, you know, on the sort of on the bullish side or on the bearish side. It's about being on the right side. And if you're doing the 10 steps, okay, this is what helps put you on the right side, and that's what we're looking to achieve. So, as I said, we'll go through that every week. I never make an apology, because I think the more you hear it, the more it sometimes sinks in. All right, sometimes, you know, we need to hear something and see it a few times before it basically sits and clicks with us, okay? So, you know, take that on board. Take a screenshot of this page, put it up on your trading wall, okay? Make sure you're doing it if you haven't been so far. So, you know, after our intro, let's talk about our main element for today, okay, which is about incorporating multiple time frames and price action. How do we utilize them together? So I often see examples of new traders just simply trading one time frame, and very often, as we said, it's kind of usually on the shorter term intraday. So I see somebody, you know, who's new to trading, and literally all they will trade is like maybe the 1 minute chart or the 5 minutes chart, okay, and they don't understand why or where so many of their trades are failing, okay, because invariably they've just got very, you know, super focused on trading maybe one instrument on one time frame, you know, and just focused on that, all right, and yet they're having challenges, and they're not really understanding where or why they are failing. But it's my belief, okay, and it is my trading belief, is that as a price action trader, we want to use the charts that we have available to us to help us build a picture of the overall market, and use that to help discover any particular bias, okay, or a specific trend. And that is where multiple time frame analysis can help us. Of course, there is the other end of the spectrum, where I sometimes see traders who've become a bit overwhelmed and suffering from analysis paralysis, when they are effectively just trying to look at every chart possible, and invariably they are just overwhelmed, okay? There's just too much information. Each of the sort of time frames they're looking at is contradicting the other one, and so they just have absolutely no idea what to do. So what we're going to do today is just invariably, we'll just talk about a very simple way to start using multiple time frames to help us with our price action trading. And as I said, it'd be interesting to know, those of you joining us here today, how many of you utilize multiple timeframes in your own trading at the moment? We saw Teresa early saying that she needed to be able to analyze all of the charts to help her with her trading decisions, and that was fabulous. But it would be interesting to know what other experiences you've had. Okay, what have you actually seen? Okay, or what has helped you in your own trading journey? And I said I'm always interested to hear that and to see what that. Marcel says I use multiple time frames. Okay, that's fabulous. All right, I appreciate that. Ruben says that I use the daily, the 1 hour, and trade on the 5-minute chart. Excellent. Okay, that's great. I really appreciate that, Ruben. Thank you very much. Okay, thank you very much. As I said, I always appreciate to hear how the people who are joining us, okay, what their own experiences. We always want to know that. William says I do use multiple time frames. Fabulous. Okay, great. So there are people here who are joining us today who've already got some experience of it, and what I'm going to do is just start the journey for people who are new to trading in terms of how can we do it, why do we do it, how can we utilize it to help us, utilize price action along with multiple time frames. Raquel says I use it as well. So fabulous. So there's clearly people here who've got some element of it, and what I'm going to try and do is just as I said, just formalize it and just start off with a simple way to use it for new traders as a way and means to help them in their own trading journey. So I appreciate there will be some people who are completely new to trading and have actually no idea what I'm talking about, and be saying, well, what actually is multi-time frames? Okay. As the slide says, multi-time frames analysis, it's the process of viewing the same instrument under different time frames. And what we normally see is that we have a higher time frame is used to establish a longer term trend or bias. Okay, it might just be a bias. It might not necessarily be a very clear trend. Okay, but even a bias is sometimes enough to help us. And then we use a shorter time frame to spot, execute, and manage our trades. As a general rule of thumb, what lots of traders will talk about, okay, lots of educators will talk about, is that they would use a ratio of 1 to 4 between the higher and the shorter time frames in terms of utilizing for the multiple time frames. But what I would suggest is that's not a hard rule, and I'll talk a little bit about my own experience, and I'll do a second session on this on a sort of, let's say, an advanced level of multi time frames. But today, we're just going to keep it nice and simple for new traders to understand. And as I said, it's a bit of a rule of thumb to use a ratio of 1 to 4, okay? And you might be saying, well, what does that mean, Paul? Well, bear with me, and I will explain all over the next few slides for you. So Athena there, it says daily and hourly to get the big picture. But being a beginner, it's still confusing. Okay, that's fabulous, Athena. I really appreciate your honesty there. That's what these sessions are here for, to help traders. Just educate them, give them a little bit of insight. Okay, just to sort of help them make a little bit have a little bit better analysis, a little bit better, a clearer understanding of what's going on, so that you're in a position to follow your trading plan. So I appreciate your honesty there. Okay, there's never as I always say, there's never any harsh judgment from myself. Anybody who's engaging trading, it can be at times a challenging journey, and we can all help each other, okay, in terms of getting to that next evolution on the stage of a journey. Because we are, even myself, who's traded for many years, okay, you're always still learning, okay, you're always still progressing on that journey, okay. It never ends, okay. You never know it all. Okay, the moment you think you know it all is normally the moment that you're about to get a little bit taught a bit of a tough lesson by the markets, ladies and gentlemen. All right, so I appreciate people interacting. I appreciate people sort of sharing their experiences. Honestly, as I said, I'm always happy to try and help with these sessions to help everybody get better as a trader. So, if we're starting to understand what multiple timeframes is and why it can be helpful, why do some traders not use multiple timeframe analysis? Why do some people just avoid it like the plague? Well, for some people, especially new traders, it can be overwhelming, all right, because they're not sure how to do it. Okay, they're not sure what they're actually doing. They're not sure how to utilize multiple timeframes. Perhaps they just don't have very good analysis skills, either because they've not learned it, they've not gone through, let's say, online sessions like our own here, okay, at Admirals, or they just basically, are just new to the journey and have yet to acquire the necessary skills. Sometimes I find that some traders, they are almost like it's like they're trading in a silo, they're trading in a bubble, okay? They just effectively, in an effort to be able to engage and work in markets, they just basically, just focus on the fewest things possible that they can, in order to basically be able to help them make a decision. And I can understand that. Okay, I can understand that to an element when you're a trader and when there's so much information, so much data, and it can be a little bit overwhelming. I can understand that, all right. But we'll talk about how to do that better in a few slides' time. Sometimes some people aren't using multiple time frames because they're just relying on hope. They just, they just see the trade, they want to take the trade, okay, and also, truthfully, some traders don't do it because they're just being a bit lazy. They just want to sort of open their laptop or switch on their phone, okay, and they just want to see a pin bar and trade it, okay, and that's what they think, that's all it takes to be a good trader, and I wish that were the case, but I can say after years of experience that is not the case, all right. So there are some people who do not use it and will not use it, and that's absolutely fine, okay. People are welcome to their own choices, okay. We're all adults, we're all engaged in markets, okay. That is what makes a market, okay? It's what makes a market. People on different views on how to engage with markets, and so that's absolutely fine. However, my view would be that multiple time frames can help a trader, and it can certainly help a new trader as well, as they are kind of learning their skills, okay, as they're upskilling themselves, in terms of analyzing markets, in terms of identifying setups, okay, managing risk, managing trades, all right, and improving as a trader. My own view is that, in terms of utilizing multiple time frame analysis, it offers you greater insight into the instrument that you're trading. And most importantly, as a trader, it allows you the opportunity to avoid obvious obstacles that may well be in place that you may not see if you're only trading on one time frame. Things that I don't want to see new traders doing is things like buying into resistance or selling into support. These are things like that, obstacles that can be avoided, all right, and that's one of the things that can actually help new traders. But by multiple time frame analysis, it also gives you the opportunity as a route to identify new opportunities, all right, when you start to sort of get good and experienced at doing it, and that can provide earlier entries, and that earlier entry might also help with improving your reward to risk ratio. Sometimes you'll hear traders call it to R3, okay, and those of you who have been with us on my sessions long will know that I'm a big fan of asymmetric reward to risk ratios, all right. If you're gonna risk 50 pips, it's because I want to be able to make 150, 200, 300 pips, okay. If I want to risk 1R, it's to be able to make 1.5R, 3R, 4R, etc. And sometimes, with a bit of experience, it might actually be able to help you spot trend changes sooner, okay. And we'll talk more about that later on in this particular session. So I believe that multiple time frame analysis can help traders. It's something that I do myself, and I think it's something that all traders could utilize in terms of a way and a means to basically help them on their trading journey. So, lots of people talk about here that invariably when they have looking at multiple time frame analysis, part of it, one of the first questions would be, well, hang on a minute, Paul, which time frames should I use? At the moment, I look at the I look at the monthly, I look at the weekly, I look at the daily, I look at the 4 hourly, I look at the 1 hour, I look at the 30-minute, I look at the 15-minute, I look at the 5 minutes. Which ones should I be using? And I can understand why people would become overwhelmed, because it's very possible there's like 6, 7 different time frames, and then invariably what we can do is you can just become overwhelmed because it might look, the instrument might look bullish on one time frame, it might look bearish on a shorter time frame, might look look like it's just consolidating, going sideways on another time frame. So I appreciate that it sometimes can be particularly challenging. That it is just a case about simplifying it and make it an easier element to start with for us all. So I think one or two people have maybe raised their hands, etc. If you want to ask a question, by all means, please put it in the sort of chat box. I'll be very happy to try and help if I particularly can. But for today, what I'm going to talk about is we're just going to have a simple plan, and we're just going to use what I would determine as a two chart combo. All right, a combination of just two charts. Now, you could use more, okay, and we'll talk a little bit about that later. But as a starting point, for those of you who are either have never done it before or have maybe been a little bit overwhelmed or a little bit struggling, but trying to understand, Paul, you know, where do I put it? What we'll have is we'll have a higher time trending chart and a lower time frame execution chart. Okay, so the higher time frame chart is what we're going to be looking for to identify, right, the sort of the trend and the bias, which we'll look at the moment. And our lower time frame is our execution chart. That's where we're going to be mostly looking for our setups, our entries. Okay, where's our stop loss? How we're going to, you know, take the trade and how we're going to manage that trade. If you are struggling to understand which one should be, well, my suggestion would be is that the lower time frame is the one you currently use the most. What I mean by that is perhaps you do most of your trading off the daily chart, okay? Because you can only trade for, you know, let's say an hour at the start of the day or the end of the day. That's absolutely fine. That becomes your lower time frame, and what we would look to use as is maybe the weekly chart as your higher time frame chart to give you the idea of a trend and bias. Maybe you are a 15-minute chart. Okay, you like to intraday trade. You like to take most of your trades off the 15-minute chart. That's okay for the moment. Let's not make too many big changes. We'll stay with that, but that becomes our lower time frame execution chart. And as I said earlier, a general rule of thumb is that we utilize a 1-to-4 ratio between the higher and the lower time frame. That doesn't have to be, you know, a hard rule. It's just one that is a starting point for us to work with. So if you are utilizing a 15-minute chart to execute most of your trades on, well, then I'd be suggesting that, you know, you utilize a 1-hour chart to give you an idea of intraday or swing levels of support and resistance, trend, and if there's a particular bias of sorts. I hope that kind of makes sense. As I said, let's just keep it simple to start with. I'll do another session in a month or so's time on, let's say, the advanced elements of it, but today let's just start with a very simple chart combo. I want it to be able to be a simple plan that you can take away and start to utilize in your own trading straight away. That's what, you know, all of these sessions we've hoped that have had that kind of idea, namely that, you know, you utilize you know, simple concepts you can take away and utilize in your own trading. Okay, I appreciate there's lots of information out there on the internet. Okay, it's very easy to get overwhelmed. Let's just keep something nice and simple you can take away, you can utilize and just progress on your trading journey. So our MTF is going to be a 2-chart combo, a higher time frame trending or bias chart, and a lower time frame execution chart. And the lower time frame execution chart, okay, if you're struggling to find out which one it should be, is the one you currently use the most. All right, because as I said, you might be trade off the daily charts, you might be taking trades off the 5-minute charts because of your own circumstances, which I won't know. Maybe you're trading around a day job, all right, or you're raising a family, or you're looking after parents, or you're running businesses, etc. You know, you all will have different individual lifestyle commitments, and so let's work with what you have at the moment rather than just trying to basically completely, you know, throw the as we would say here in the UK, throw the baby out with the bathwater. Let's start and let's evolve in our trading. So with that in mind, let's just go into that a little bit more detail. If we're using a two chart multiple time frame combo, then as I said, the higher time frame is what we look to establish things like levels of support and resistance. Remember what we sort of said, you know, in our price action trading plan, step 1, right? Drawing in your levels of support and resistance. We'll utilize that to identify any directional bias. And here is where I would suggest sometimes bias and trend can be quite different. So in an ideal world, I always want to see if there's a nice clear trend. But as you'll know when you trade for a while, there's a difference between what you want and what you get. But for me, if I see something like here, this is I think it's a chart on dollar against Japanese yen. That's the 1 hour chart. I think that's the 15-minute chart. Hopefully you can see that there is a very clear trend in place there. Okay, very clear trend, and we like to see nice clear trends, but we don't get them as much as we want. Whereas actually a bias might well be that I may have a bullish bias, I may have a bearish bias based upon higher time frames, but actually the price isn't necessarily in a clear trend because it's grinding its way, okay, higher or lower. Maybe there's a good deal of volatility, so I would have a bias, but I'm also aware that there's not a clear trend. In an ideal world, I want clear bias and clear trend, but it's a case of what you want and what you get can sometimes be very different, and you have to adapt to what you see in front of you. All right, that's what we're talking about here. But what we also want to use our higher time frame is to establish any particular obstacles, any particular clear obstacles, things like big round numbers that we are running in towards, okay, where we can see maybe on the chart where there's maybe periods of consolidation, which might be an area that provides support or resistance based upon the direction of a trade, and also areas around where there may be particular levels of volatility. Maybe it's because there's a particular level, okay, that the market seems to sort of be either drawn towards or is pushed away from, or the price action is very scruffy. It's not very clean at all because for whatever reason, sometimes it's clear, sometimes it's not, that there is volatility in that particular area. It can also be used, the higher time frame can also be used to identify possible targets. It might well be that the way we trade is that we might actually have a couple of targets for a trader, sort of a shorter term target and a much further away longer term target. And our higher time frame can sometimes be used to establish that, okay, and that's what can help us. So that's what we'll be looking for, okay, and that higher time frame, whether it's a 30-minute chart or a monthly chart, okay, depending upon how we look to operate, that is what we're looking to achieve on that. So regardless of whether you're a position trader, an end of day trader, a swing trader, an intraday trader, a scalper, that's what we're looking for from our higher time frame. So it'd be interesting to know from the people who have joined us here today, from the people who have already said that they use multiple time frames, it would be interesting to know what the time frames in specific that they utilize themselves. Maybe they have much wider gaps, okay, between the time frames. Maybe they're much tighter. Maybe they use, much higher ones. Maybe they use much lower ones, depending upon their own trading styles. Be interesting to know. Put your own experiences in the chat box, and we can chat about that. But on the flip side, well, we want to look at, well, what are we going to utilize our lower time frame to establish? Well, if there is a trend, I like to trade a pullback in a trend, okay, and so I'll be looking for that on a lower time frame. That can help me. My lower time frame, my execution time frame. It might also give me an early indication of a possible reversal. So if I'm already in a trade, if I'm already sort of running a trade, I might start to get an early indication of a possible reversal. We don't really know at the start. Maybe it's a reversal, maybe it's a retrace, maybe it's just, maybe it's just a small pullback as part of a bigger move. You don't know, but you're likely to get an earlier indication on the lower time frame. And we also want to see our trade setups, okay? And when I talk about trade setups, those are the sort of trade triggers that we have talked about throughout this price action series, okay? So things like pin bars, engulfing candles, star formations, key reversal formations, inside bars, counter trend line breaks, etc. There's been plenty of trade setups, trade triggers, price action wise that we've shared with you. If you're not too sure about them, remember all of these are on the Admirals YouTube channel. By all means, make sure that you go and take a look at it, and you can actually work with that and just brush up if you need to. So Teresa says she uses the daily, the 1 hourly, the 15, and the 3 minutes. Okay, so there's a fair broad spread. She's using 4 charts there. Okay, and as I said, you can utilize quite a few. And what I'll do is in the advanced session, I will talk about my own experience. I tend to like to use 3. Okay, but today, as I said, it's an introduction. Let's just talk about 2 sessions, a two-stage combo, multiple time frame. All right, okay, a higher and a lower. But thank you, Teresa. I appreciate your insight there and your contribution. So with that in mind, let's have a few examples here to understand what I'm talking about. So what I have here is it's the Euro USD. Okay, the Euro USD are on both the weekly and the daily. So if you look at the weekly and the daily, is actually the ratio is about 1 to 5 as opposed to 1 to 4. So remember what I said, that's what we're ideally looking for, but it's not hard and fast. It's a natural, okay, it's a natural distance between the time frames in terms of the weekly and the daily. That's what can be used, and that's what we actually look to sort of work with. Ruben says, I use the daily for the high and the low of yesterday, the 1 hour to establish the direction and the support and resistance, 5 minutes to execute the trade. And that's excellent. Ruben's clearly got a very simple plan there, hasn't he? Okay, and simple, utilizing 3 different time frames and each one providing a part of his particular trading plan, and all are very smart. Okay, daily for the high and lows of yesterday, 1 hour to establish if there's a direction and any support resistance, and then execution on the 5 minutes. Okay, so even there you can see it's more than a 1 to 4 ratio, but as I said, it's a rule of thumb. It's not a hard rule. Okay, it's about having a simple plan that you can work with in terms of utilizing multiple time frames to help you make better trading decisions. So thank you for that, Ruben. I appreciate your contribution. But and here in this particular case, euro dollar weekly and daily, and this is actually from last year, from last summer. This is the weekly chart, and I'm hoping that you can see that we had a very clear trend on the weekly chart. Okay, we were beneath the 20, beneath the 50, beneath the 200. The moving average is in a very nice fan. In terms of price action wise, we were in a very clear trend, okay, making lower lows, lower highs as we worked our way down. In fact, what happened is we worked our way down to at that time at parity between the euro and the US dollar. And so, we had a very clear trend, okay, and we were also able to draw in significant levels of what would have been support for us as we worked our way down, and we could identify, as I said, kind of significant big round numbers that might be of interest. And it's when we go down to the daily chart, okay, the daily chart, as we know, established that we were in that downtrend. Well, what we were looking for is, pullbacks, okay, bearish pin bars at the end of pullbacks, okay. This one failed, okay. It actually pulled back to the 20, but it didn't follow through. It actually needed to pull back deeper. That's one of the things that can happen with if you're utilizing pullbacks for an entry. Sometimes the price just needs to pull back further and deeper. And that's okay. All right, that's okay. That doesn't. If your first trade, failed, but it's met your plan, but it failed. That's okay. Doesn't mean you're a terrible trader. Sometimes price just needs to pull back deeper before it moves. Okay, and that's what we saw there. So it was a case. Remember, we're using the weekly chart as our higher time frame to establish if there was a clear trend, and in this case on euro dollar there was. Okay, were there particular levels of support and resistance that we needed to be aware of? Were there things like big round numbers? Okay, all of these kind of things that are of interest to us, and then actually the daily chart is what gave us the opportunity, all right, to sort of take trades using price action triggers on pullbacks, and also what we also had here, which is maybe difficult to see, is that once we'd hit the parity number and we'd gone past it, well then basically what happened is we put in a bullish key reversal, which became a double bottom with another bullish key reversal before we moved higher. Okay, so we were on the lower time frame. We were getting an early indicator that downtrend was starting to look as if it was running out of steam and getting ready to reverse. So Ruben asks, which moving average are you using on your daily? I always use the same ones, okay, Ruben. So I have a blue 20 simple period moving average, a red 50 period, and a green 200 period moving average, okay? So I am a big fan of the 50 period moving average. I think that it, especially on the daily, it can act as almost like a barrier, as almost like fair value. Okay, if there's anything that you could define in a market, okay, and so pullbacks to that in a trend can be great places to sort of take a pullback entry using a price action trigger. So good question. Thanks for your question there. What we had here, this is actually from earlier this week. Okay, in fact, it's from Monday, Tuesday of this week. Is that this was the dollar yen, and this was where we had a 60-minute chart and a 15-minute chart. Hopefully, you can see on the 60-minute chart. Okay, we were in a pretty clear trend. We had strength in the US dollar, weakness in the Japanese yen. Price action played that out. We were above the moving averages. We were making higher highs, higher lows. But on the 15-minute chart, okay, that was that 1 to 4. This was, this was our higher time frame. Okay, bang, higher time frame, and this was our lower time frame, our execution. Okay, and what we had was, as you know, if you're an overnight Asian trader, well then basically we had returns to the 20-period moving average as price moved up in that particular trend. Okay, and that's what we're looking for. Remember what I said here. You're just utilizing the higher time frame to identify trend, or if there's any significant levels of support resistance in front of us, and then utilizing the lower time frame as a way and a means to find our entries in line with our normal sort of trading plan. Raquel says she uses the daily for analysis, the 4 or the 1 hour for day trading and for scalping. And I also look at the daily for an overall picture, then look for setups on the 30-minute chart, then execute on the 3-minute chart. That's great, Raquel. Okay, thank you. I appreciate that. All right, appreciate you giving us, sharing your experience. That's really good. Gives traders an opportunity to realize, as I said, you've got a higher time frame for your analysis. Okay, looking for the overall picture. And then you're able to execute it on a lower time frame, and that's what we're trying to do here. This is just as I said, we're just utilizing a simple two chart combo here. You can make it more complex, as complicated as you want. My own view is, less is more. Okay, to start with as a trader, keep it nice and simple so you can actually work out what you're working with. Here we go for another. You can tell that I do quite a lot of longer term swing trading. This is Swiss franc against Japanese yen on the weekly and the daily chart. Hopefully you can see on the weekly chart for this year, it has been a very clear trend. Swiss franc has been very strong. Japanese yen has been very weak. And when we go down to our daily chart for execution chart, well, actually what we saw was that, in terms of bounces off the 20-period moving average, okay, with our price action, there's been a fair amount of those, okay, over these last few months, because we've had a very clear trend, okay, on the weekly chart. Okay, remember what I said, that's a very clear trend. You've got a clear trend and a clear bullish bias as well. So every time there's a little bit of a pullback, we've got counter trend lines there. Okay, flag patterns, pin bars, bounces off support, etc. All of those simple price action triggers we've talked about, just utilizing it just to give us the opportunity to trade in line with the sort of the bigger, deeper, stronger trend. I think I've put quite a few examples in here. Yep. So this is the Nikkei, the Japanese index, and this is about on the sort of the daily and the 4-hourly. And as I said, if you think about it, for a daily chart, 24 hours, if you're using a 4-hour chart, it's not a 1 to 4 ratio, it's about 1 to 6. As I said, it's not a hard and fast rule. Okay, it's just a case of of using a little bit of what is available to you, and just basically using a little bit of common sense. All right, so for example, there wouldn't be a massive amount of use of using, let's say, the weekly chart as your higher time frame, and then the 5-minute chart as your execution, because there's just too much distance, there's too much data, too much price action has moved, okay, on a weekly chart and a 5-minute chart. All right, so if you're just looking to start, a 1 to 4 ratio is fine. Okay, 1 to 5, 1 to 6. Okay, just make sure it just doesn't get much bigger than that, because otherwise there's a divergence between what perhaps we might see in terms of trends and bias and movements. So the Nikkei on the daily chart, well, those of you who've been following the kind of Japanese markets would see that, for the last few months, we had a very, very clear uptrend. All right, remember, I want to see a clear trend if there is one possible. I'm not here to fight the market. Okay, when I'm utilizing this, I want to surf these waves. I want to flow with it. And so hopefully you can see, that has been, it's above its averages. It's making, okay, higher highs, higher lows, higher highs, higher lows as it goes. But then actually when we go down to the 4-hour chart, well, we can see as we're getting above the moving averages are pullbacks. Okay, pullbacks are ended by price action. There are a little bit of pin bars, bounces off 20 and 50 period moving averages. But even though we did have two failing trades there. Okay, there is no perfection. Okay, there is no perfection. There's nothing that ever offers you 100% guarantee. If anybody tries to tell you that there is in trading, they're talking nonsense. All right, but just remember what I said earlier, is that sometimes when we're in a trend, the price may pull back and set up, okay, but fail because actually the price needs to pull back deeper. Just remember that the price just might need to pull back deeper, which means that you may have been washed out on the first trade, but if price pulls back a little bit further and then sets up again, as in there's good price action, okay, for good level, in this case of support, that in itself is a fair trade. Okay, that is not revenge trading. Okay, revenge trading is where just because your trade got washed out, you just basically back into the market regardless. As I said, if price is pulling back and you're washed out, price just may need to pull back further. Okay, might just need to pull back further. So watch it. Okay, watch the price action, see how it sets up. Does it set up again? Because that might be your next opportunity. And here's gold. Okay, earlier we had this is the 4 hour and the 1 hour chart, that 1 to 4 ratio. The gold on the 4 hour chart here, you can see that just at the sort of end of July into August, about a month or so ago, we had a very nice clear trend on the 4 hour chart. Price was beneath its moving averages. It was making lower highs, lower lows, lower highs, lower lows, just what we expect to see. And you remember what I was saying, that the trend was actually quite nice, quite clear, quite it was how would you, a good way to describe it, it was very clean trend. Okay, it basically a great deal of respect for things like the moving averages and levels of support and resistance. And on the 1 hour chart, as you can see, is that we would have pullbacks. Okay, pullbacks to areas. Okay, pullbacks to off the trades. Okay, pullbacks to moving averages. And that was what would provide opportunities, okay, to take a trade, execute trade in the direction of the higher time frame trend. All right, and that means that our opportunity, when we're surfing it, okay, we're surfing those waves. That gives us the opportunity to take good trades in line with the trend, and gives us the opportunity to achieve our trading targets and objectives. As always, I like to give you a little bit something just to take away and work with. So if you haven't been using multiple time frame analysis, just go back and take a little look at some of your most recent trades. Did you use MTF analysis? If not, why not? Were you being a bit lazy? Did you not really know how to do it? Okay, were you just not really sure what you were doing? Well, take a look at that trade. Okay, would it have helped if you'd have been able to identify a higher time frame support, resistance, whether there was a trend, whether there was a bias? And could you build a trade plan around higher time frame analysis and lower time frame execution? Okay, what I see is that I suspect you probably can do. Okay, in fact, I know you can do it, right? Because plenty of people do it. Having a higher time frame, as I said, analysis chart, and then a lower time frame execution chart. And as I said, and once you start to build that and start to recognize some of the nice combinations, okay, so things like people using weekly charts and daily charts, or daily and 4 hour, or 4 hour and 1 hour, or 1 hour and 15 minutes, okay, things like that can actually just help you. All right, just help you identify, have a very simpler way to engage with markets using multiple time frame analysis. Ruben says it's the only way. Absolutely, spot on. Okay, spot on. Good comment there, Ruben. So, ladies and gentlemen, in conclusion, okay, so we've spoken plenty now about how price action analysis is just a way of analyzing price movements over time, in markets, and we are looking for price action triggers at significant prices, levels, or zones that allows us to build a simple price action trading plan. Today is just another version of that. Okay. Multiple time frame analysis is the process of viewing the same instrument under different time frames, and we usually use a higher time frame to establish if there is a longer term trend or bias, and then a shorter term time frame is used to maybe spot, execute, and manage our trades. The general rule of thumb is a 1 to 4 ratio between higher and shorter time frame, but it's not a hard rule. So, you might have let's say a 1 hour chart, okay, for your intraday trend or bias with a 15-minute chart to find, execute, and manage those trades on. And as I say, look to start with the sort of 2-chart multiple time frame combo that we've just talked about here, in this session today. You can make it much more complicated, and you saw here from some of the fabulous people who are joining us, contributing, that some people use 3, some people use 4. It's absolutely fine. I'll do an advanced one, okay, a session on this based upon my own experiences. But for traders to start with, 2-chart MTF combo is just a great, simple way to start. Nice. Keep it simple, okay? Keep it simple. Keep it something that you can actually work with and utilize and do with your own particular trading. So Ruben says, according to your experience, what is the moving average to use in the 1 hour to establish direction? I use the 50 and 25. I wouldn't disagree with you there, okay? I'm a great fan of the 20 and the 50, okay? There is no perfection when it comes to using a moving average. You could spend the rest of your life trying to curve fit moving averages to every single instrument, and I know traders who will do that. Okay, and I know traders have done that, and that's absolutely fine. Generally, I'm only utilizing moving averages to just confirm the trend, which you should be clear from the price action, and also to utilize it as an area of dynamic support resistance that, if I see price action triggers at those moving averages, that's a nice pullback that I can take the trade off, and I'm very comfortable with that. So I've overrun a little bit, but let's go for just a quick minute onto the charts, shall we? Okay, but before we do, remember what I said, okay? Next Wednesday, 13th of September, is session 50, and it is all about how to get your price action questions answered. An AMA, Ask Me Anything with Paul. So we'll do a quick recap of what we've learned so far, and it will be quick because we could spend weeks doing that. But I'm going to talk about understanding traders' challenges, and it will also be a chance for you to ask your questions to a trader coach, right? To ask you, in particular, your price action questions, but some of your questions about trading as well. It's something we're going to try a little bit different, okay? I hope that you will join us, okay? Because if you join us live, that gives you the opportunity to engage with us. So that is next Wednesday, 13th of September, 2 o'clock London time. Check your inbox for the webinar link, and or head over to the website. Okay, Athena says, "Thank you, Paul. You're very welcome. Okay, thank you for joining us. If you want to contact us, you can do. You can see all those ways and means that you can touch us. What you will also find is that we will send out a feedback form straight after this session, and I'd really appreciate it if you took a little bit of time, just the 30 seconds, just to fill that in. It's also an opportunity for you to put down if there's anything you'd like to see us touch on in the future. I want to make these sessions as useful and as valuable to you as possible. So if there is particular ideas or thoughts, then you're very welcome to share them with us. So we're overrunning a little bit, but let's just have a quick look at the charts for today, because let's just see what's been going on. And I'll just give you a little bit of maybe a hint of what we'll touch on in the advanced session. So just bear with me one moment, and we'll switch across to the Admirals charts. So boom, boom, boom. Let's just bring these up here. Okay. All right. So here we go, and bang. What I've got up here is, I'm hoping you can hear me, hoping you can see the chart. This is my dollar profile here. Hopefully you can see there at the bottom. I'm going to talk a little bit about advanced elements here, because what we're going to talk about in a future session is about that, is namely how we can utilize the higher time frames to maybe even give us an idea of where the lower times may be going. Okay, so we're able to establish ourselves which way we want to be trading. In this particular case, as I said, this is the dollar profile, and what we had for July here. I'm hoping to see, this is here. I've got the pound against the US dollar here. What we had here on the monthly chart was, that was a monthly pin bar off the basically the 130 level, and also the monthly 50-period moving average. The euro against the US dollar here did exactly the same. Okay, did exactly the same. It printed even though it was a bullish close, a bearish pin bar off the kind of 111, 112, 50-period moving average there. The Aussie dollar okay, did the same. It printed an inside bar, pin bar, this time off the 20-period moving average because we were already in a very clear downtrend. And the Kiwi dollar did the same as well. Okay, so that was a case of, on the higher time frame, getting a correlation of views. Okay, the my dollar index chart isn't working too great, but it was the dollar index did the exact opposite. Okay, so it's an inverse correlation to the other the majors. But actually, seeing that was able then to basically give us, the higher time frame was giving us that the likelihood was that we were probably going to sort of draw down. Okay, we were probably going to move lower, and that's exactly what we did. And that information, when you start to look at it on a lower time frame, starts to make it a little bit clearer about what you can actually utilize. Okay, so what we had was on the weekly chart. Having printed that, we had like 6 or so weeks there, okay, of drawdown, or basically moving lower. We had dollar strength, Aussie weakness. That's what we want to work with. The daily chart, okay, when we look at that, that was providing us with a very clear trend for about 5-6 weeks because of that, which we wanted to work with. And then also here we go, the 4-hour chart. Let's just zoom out here a little bit. The 4-hour chart in that period as well was a very nice clear trend. And so that's how, not only can we use the higher time frame to identify levels of support and resistance, whether there's a particular trend. Also, when we're looking at much bigger picture, we can use that as that correlated view to give us an indication of where the likely direction is for the next, what could be 2 weeks to 2 months. But that in itself is enough for us to be able to sort of trade and execute on lower time frames. So there are, as I said, once you start to understand, then you can start to build out a plan to utilize higher time frames to identify the bias. Okay, identify the bias, or if there's a trend, and the lower time frame to be able to execute with that. So that's something I shall go into more depth on in the advanced multiple time frame session, which it'll probably be, I think, probably maybe the start of November, so about 5 weeks or so, 5-6 weeks away. But be sure to put that in your diary, okay, to for when we look to cover that. Boom. Okay, ladies and gentlemen, unfortunately, we kind of, have run out of our time. We've overrun a little bit. I try to cram in as much as I possibly can, ladies and gentlemen. So I do appreciate a fly through it. But all of these sessions are recorded. They will all be on the Admirals YouTube channel. So be sure to make sure that you're able to watch the recordings and enjoy them. As I said, I appreciate if you fill out the feedback form. It'll get sent to you straight after this session. And also next Wednesday is a chance for you to have your price action questions answered. So be sure to join us Wednesday, 2 o'clock London time. Bring some questions, okay? Send them through. I'll gladly answer them if I can. And until such time, I hope you have a fabulous trading week, and I'll speak to you soon. Trade well, everybody, and enjoy your week. Thank you.